managers who start on their own without a platform, like you and me, we get a dog, a
Yeah.
spreadsheet, and we go to our garage and start trading. The survival rate is somewhere under 35%. Okay, it's close to one third, meaning that we're not going to make it to year
Yeah.
three. Right? The statistic on our platform, the survival rate is over 65% for that you will survive for more than 3 years.
Welcome back to the Fun Seed Arise podcast, where we explore what it really takes to go from independent trader to institutional grade money manager. I'm your host, Emanuel Balarie, and today we're diving into a part of the capital raising landscape that's often misunderstood, but increasingly important for emerging managers, the Asian allocator ecosystem. Our guest today is someone who sits right at the center of this world, Alvin Fan, the CEO of OPIM, the leading Asian-based fund platform and seeding partner for emerging managers. Alvin has spent more than a decade helping managers launch, scale, and institutionalize their strategies while also working closely with Asian family offices and allocators to identify talent worth backing. He brings a unique perspective because he sees both sides, the challenges emerging managers face when trying to raise capital, and the criteria allocators use to select and trust new talent. Today's conversation is about bridging that gap. Alvin, it's great to see you here. Thank you for joining us on the show.
Thanks for having me, Emmanuel. It's been a minute, and
Yeah.
big hello to all of our friends out there in North America and Europe.
Yeah, I'm excited to speak with you, Alvin. As you know, we've known each other for years. And so just for our audience and for those who don't know your journey, can you just share how you became involved in the alternative investment space and how you ended up launching OPIM and specifically working with emerging managers in Asia?
Yeah, so my background is pretty, well, I wouldn't say it's unique, but it's pretty uneventful. I'm born and raised in Toronto, Canada, Western grad, went to Ivy School of Business. Somewhere in that, in the late 90s after the handover in Hong Kong, I decided to come back to Hong Kong. Started my career at IBM working with the local teams to help do some restructuring, implement the direct model, which was really popular with Michael Dell, and then went back to B school. As I came out, decided to move into private equity. I come from not a family, but I have several uncles who have really inspired me to move into investment banking and finance. And so after I finished B school, I joined a small VC PE firm and spent the larger part of 4 or 5 years in Romania, in Macau. We were one of the earlier investors into Macau before the big casino run. And then there was one more place. Oh, Berlin. That's right. We'd spent some time in Berlin and Thailand. So some very frontier markets, and most of it was looking at distressed assets. Cut my teeth on learning about, the basics of direct investing there. Then moved on to join Oriental Patron Group, which is one of the oldest partnerships in Hong Kong, and still is. I've been here for, almost about 15, 16 years now. I think it was 2009, just after GFC. In the previous fund, we returned all of our capital. It was a Romanian fund. We returned all of our capital to investors. And then I joined OP Group and helped them work on their publicly listed private equity fund. It was there I sort of came across one of my investee companies was the early iteration of OPIM, which was basically a small asset management company with a couple of managers. And there was this idea of building a fund with one of our partners, Penjing Asset Management, Ronnie Wu, who's the CIO there. And we had put together some capital to seed, 8 to 10 of these early stage managers. And the idea was that it was kind of like a manager of manager structure where they would join us on the platform licensed under us. Meanwhile, we would have a fund of fund structure that would allocate into their sub funds underneath. And some of them were semi-external, meaning that they had their own fund structure but were licensed under us, and then there were those who were under a sub fund under our vehicles. I won't get into the technical details, but essentially, out of the 8 to 10, we had 3 rock stars, and it was quite successful. And so the idea was, how do we grow this? And we realized very early on that there was always going to be a question around the conflict of interest between for investors who are allocating into the umbrella vehicle, whilst we're also the manager of the underlying manager. And so we decided at that time to split up the company, and Penjin took over the fund of funds, and OP, we decided to double down on this idea of growing the infrastructure, the regulatory compliance, risk management side to help early stage managers build up track record and grow. So now that was roughly 10, 12 years ago. I moved down to OPIM full time. We raised some internal capital, started with a team of 6, I think it was, and only like 3 managers. And now we're running a little over 45, I think, year to date. We're 45 strategies across almost 2 yards of capital.
Wow. For our listeners, 2 yards?
2 billion.
In case, of course, sometimes when you crack the multiple billion level, you don't want to say billions. You just want to say 2 yards. No. So Alvin, that's one of the things that you know probably since when you started, right? The industry has changed drastically. Where from an allocator perspective and from a manager perspective, it's now global. I know you've come to the US. I've come to Hong Kong, and we met in Singapore. If you recall, we couldn't find a cab in Shenzhen. That one time we were walking around for a while. Can you give us from your perspective, because you do have this unique lens, the different ways that Asian allocators evaluate managers differently from those in the US or Europe? And how do they look at sort of that process of evaluation? And how do they think about talent? How do they think about track records? And just anything else that you might add?
Well, when we say how do Asian allocators look, so there are a lot of countries in Asia, right? You have Australia, you have Japan, China, Southeast Asia, Singapore, and the different countries from an institutional level are at varying degrees of sophistication. Surprisingly, Japanese allocators or institutional allocators are only just starting to look at absolute return alternative exposure, and this has been widely published and widely noted in the news in the last 18 months or so. But before then, it's been an incredibly conservative allocation model, right? And meaning that their cost of capital and their risk appetite is very, very low. And then you have investors from, say, like Taiwan, institutional investors from Taiwan who are a little bit more like institutional investors globally, who have been active in the absolute return space a little bit longer. China is naturally, Chinese institutional allocators are obviously going to be very conservative as well because of capital controls. So for them to bring capital offshore, it's very, very challenging to bring capital offshore. So they're naturally going to be in the capital preservation mode when they're looking at money managers, and so they're typically going to go for top shelf branded names, etc. And the rest of Southeast Asia, be it in like Singapore, basically really just Singapore, they're going to be a little bit more sophisticated, even across the multifamily offices. But those ticket sizes are naturally going to be a bit smaller than you would see from the U.S. Middle East is a different ballgame, obviously, because institutional investors and family offices are basically synonymous. And so when we look at them, they have kind of the fast moving and very quick to make decision type of structures, type of decision making flows and processes, but they're very institutional.
Middle East investors.
The Middle Eastern investors, yeah, they're very when they have a view or they're taking a view, they're able to move very, very quickly, similar to how, say, a Chinese institution can move. But because and that's because their family offices and still very centrally controlled, but their due diligence process is incredibly sophisticated, meaning that they do have a full internal team who are very well versed in operational due diligence, risk management. So though they can move fast, it's not without It's not with high degree of professionalism.
So what I hear you saying is when we talk about Asian allocators, it really depends on the different countries and different regions. I'm curious of I mean the 2 billion that you have under management, the 2 yards, most of that, predominantly all of it perhaps is allocated to emerging managers, what we call emerging managers.
Yeah.
Can you tell us like the percentage or the regions where you know these countries are more open to allocating to emerging managers?
Yeah, so I guess I just touched on the institutional investors. The mid and I guess the family office investors are a little bit more active. And so here's where the dynamic is interesting. In Europe, US, we're looking at multi-generational, third, fourth generation, sometimes even fifth and sixth generation families with already an established investment committee, mandates, but you also have a lot of mouths to feed. You have a lot of different arms of the family that you need to ensure a very, very strong corporate governance and clear mandates as they look at allocating globally. So it's very institutional from that perspective because you have more decentralized interests. In Asia, we're still looking at first and second generation family offices. So what does that mean? That means these decision makers are still have maybe one foot in the business that they've been building for generations. They're still very entrepreneurial in nature. And so their expectations and their involvement in the allocations are still very, very high. It's not until you get to second generation, between second and third generation, do we see this, number one, the very concerted transfer of wealth and power, and finally the growing of the tree of the family members as we move down the generations where, decentralized interests need to be accommodated for. That's when you start to see more institutionalization, more corporate governance. We're slowly moving to that space, but we're still between Gen 1 and Gen 2. And so that means that these are allocators who are risk takers, especially if you can build that trust with them. But when we talk about risk taking, it's on multiple dimensions. It's not necessarily just what is the rate of return, what is the absolute return of your business. Sometimes they're interested in the equity of your business as well, kind of like a seeder, because they themselves may see the or have the vision of building their own asset management company. And the idea of growing deposits, the idea of growing not a bank, but certainly a small financial institution could be in their purview. And so when they meet with managers, sometimes we see managers start as external managers get digested into the family office as a result of this. So that's where most of the capital who are deploying money into the emerging managers on our platform are currently. And so that's probably the most active space right now. And for better, for worse, they're learning as well, right?
Yeah.
A lot of them are learning about risk for the first time. And this is an entrepreneurial venture for them.
Yeah, that makes sense. So it's, we talk about in part of our Fund Cedar Rise cohort and in general talking to emerging managers. One of the things I try to articulate to them is, make sure you're in front of the right investors. I mean, you don't want to get lost in the weeds of a 1 year sales cycle with an institutional investor that might be just wants to just check the box and they'll never allocate to you. And what's interesting about what you just said, and I've never thought about it, is in terms of the family office allocator, which I think everybody wants a family office allocation, but very difficult to crack into that. The first or
Yeah.
second generation are much more aligned and entrepreneurial to allocate to an emerging manager than one that's established, and out there. Is that accurate?
Yeah, it's kind of polarized in a way because the
Yeah.
first allocations that they make are typically going to be branded because they're like, we're going to be taking, it's very difficult for them to get capital offshore for one, or to be able to structure their capital into a safe spot where they can start to allocate for generations. And when they do, their first port of call are going to be the big names. So top shelf names, the KKRs, the BlackRock, etc. But emerging managers, there's always going to be a sleeve for that because their relationships that they built over time, maybe second generation have built relationships, or maybe they went to school together, or maybe second generation were educated in finance and they want to build it from scratch. And so they might partner with an experienced investment manager to build the shop internally or externally. And so that's where you get a lot of seeding activity come in. In other cases we've seen as well, especially in China, is the growth of multifamily offices, where you have single family offices who are now extending their services to other smaller families, other families who are close, but who do not have a strong enough financial network. And so these multifamily offices start to grow, and they may also build their own internal manager of manager structures as well. And we've seen quite a few cases of that, and we built some structures for them as well.
That's a good point. Asia has a reputation, and I say Asia, but for just being heavy relationship driven, like you mentioned,
Yeah.
whether it's somebody he went to school with or a multifamily office. Is it virtually impossible then for an emerging manager out of London or the US? And is it a waste of time for them to take a flight to Hong Kong to try to raise capital?
That's a really good question. I think typically with any cross-border venture to raise capital, you have to take it with, you can't be a tourist about it, right? You have to really be committed to that move, right? Same thing could be said if our managers got up and said, we're going to show up in Miami, we're going to show up in New York, or we're going to raise capital. It's not that simple, right? You just can't, suitcase your way in and raise capital that way. There's naturally going to be, number one, home-based bias. And number two, it's not like there's an open Rolodex that you can Google and say, okay, here are the family offices that I want to meet. Can I see them? Those that are searchable are typically well invested already. And so they're going to have a good
That's the
relationship
that's
with the
the
prime
that's the
brokers.
third or fourth generation they were talking about.
That's right. Exactly. That's third or fourth generation. Yeah.
Yeah, interesting. And have you seen in sort of this length of time that you've been working at OPIM, have you had success stories of a US based or a European based manager come to Hong Kong, interact and raise capital and do well? And then vice versa of managers that you've represented here in the US. And I know these are kind of hard question, but I am curious of if it's that home based mentality, especially in Asia, the relationship driven where it's like we're looking for people who have a presence here. Otherwise, we're not really interested unless they're the big millenniums of the world.
Yeah. Now, having said that, having said what I said, when I say not being a tourist about it, it just means that you need to build a campaign when you travel overseas to do marketing. Similarly, if U.S. managers are coming to Hong Kong, the more successful ones have dedicated quarterly visits, sometimes monthly visits, and have maintain very, very close communications with the contacts that they've made here. And they work very closely with the prime brokers as well as cap intro teams to get them, in front of the right investors. US investors coming to Asia, you're still faced with a lot of competition, probably more competition than Asian managers have with each other because there are just so many US centric emerging managers like iConnections, for example, right? Like iConnections is like 1,000 managers. Like this is not five. There's like 500 to 700 managers, and then and there's only like 250 LPs. Like it's a huge population, right? And so much so they had to take up two conference facilities across two hotels, if you remember, right? And it's like the biggest speed dating event of the year, right? So coming to Asia, there are managers who have done well. I don't have any examples off the top of my head, but again, it's a matter of showing very consistent, strong returns, but being able to differentiate yourself, not necessarily against other Asian managers, but US managers differentiating themselves from the top shelf names. That's usually the harder thing to do. And so if you're doing, and more specifically, let's say the average return for like a Vanguard fund or whatever is like, 15%. It's like an active beta plus strategy, equity long bias, but your firm comes in at 17% over the top. From the perspective of the investor here in Asia, it's the same question. Am I willing to take franchise risk for the extra 200 basis points of performance and knowing full well that my prime brokers or private bankers from JP Morgan all the way down to Julius Baer are going to introduce me to another 500 from iConnection in Miami.
Yeah. Yeah.
So that's always going to be the challenge. And not to say that you can't, but you do need to come in and build that relationship as a result.
And I think that's the point. And really, actually, whether it's in Asia or in New York or Miami, for emerging managers and traders looking to transition, it's all relationship anyway. And I know you and I, like when you've made introductions when I've been to Asia, and I've made introduction when you've come, and that's really the space for emerging managers, because otherwise, the allocators themselves are are inundated with other offers, other opportunities, and you have to crack through that relationship game. Probably no different again in the US as is in Asia.
Yeah, I think the real question is how much, as of today, compared to say 5 years ago, how much of it is relationship versus performance? Because it's a more of a granular scale, right? And I would say that performance on one hand, performance expectations have come down a lot, right? Before, say 5, 10 years ago, when I first started building the company, performance expectations compared to market were really high. Like if you didn't generate, 20 plus return, then it's really not worth it for investors to come across the pond to allocate. But then you also had to match that with a very, very robust risk management profile, which is sometimes hard to balance, right?
Yeah. Well, and that's actually a good point. I mean, that's kind of transitioning to some of the practical things that, allocators and the ones you deal with look at. And you talked about, performance, and, when you meet an emerging manager for the first time, right? And they're coming to you and they're saying, Alvin, like I'm like the best trader ever. I mean, take a look at my performance. Like, can you raise me $100 million? Right? Like, what are some of the things that you really assess to say, okay, look, like you're not ready yet, and these are the things we need to set up before we actually take you to an investor. Maybe you could take us through that case study of a trader, emerging manager that's looking to get institutional ready.
Yeah, it's kind of like being in high school again, right? You have talent and then you have skill and you have track record, right? How are your grades? You have a son and you know he has certain talents, but then you also are acutely aware that he needs to prove out those talents over time. And so typically with any manager who's starting out their business, as an allocator, they're looking for that je ne sais quoi, where that articulated edge is. And it's really important that the manager is self-aware enough to be able to articulate that edge. If they just show absolute numbers and here's my absolute returns, blah, 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 but they can't really break down quantitatively where that alpha comes from, you're naturally going to be on the back foot because investors, especially those who have relationships and who can bring other investors to you, they're going to be the toughest nuts to crack on day one. And you want to be as self-aware as possible. And it's incredible how many really talented managers are not self-aware. They have an intuition or a sense of where that alpha comes from, but they probably haven't spent enough time analytically breaking down where the alpha came from. The second thing that we look for obviously is pedigree, right? And this is for better or for worse, it's just something that allocators feel more comfortable about. And there is a difference just because you come from a big shop, say like sell side Goldman Sachs versus buy side Goldman Sachs are totally different, right? You come from buy side point 72 or GSAM, etc. You're naturally going to get a lot more airtime with the investor because it'll be clear in your conversation that you have practiced the art of running a portfolio. A lot of teams who come from sell side have a hard time transitioning that over, and allocators are very aware of that. And so they're typically going to need a little bit more time to see how you manage yourself psychologically and how you manage the business of running a fund coming from a sell side background. Whereas if you came from a buy side background, you're naturally going to be given a few extra points. The other aspect that we look for is the difference between, say, paper portfolio versus live capital, right? And there's different variations or levels of live capital. Paper portfolio is really good because you've spent the time to build it, etc., but it's not been run live. So since it's not live, it's not going to be enough to get second day investor, perhaps even an anchor investor. It might be enough to get a friend to put capital on because they believe in you, but it might not be enough to get the big tickets yet. So you need to have that live capital running, whether it's in a PA form or whether it's in a very, very simple structure, maybe an SMA. That would be, my advice on getting live capital done. It would be an added benefit if you had it audited or if you had an opinion from a CPA or a third party to show that, hey, this performance reflects the account. And that helps a lot too. Now, that aside, we're assuming that there is performance. You do need performance. And so what is performance, right? And naturally, performance really depends on the type of asset class and the strategy that you're competing with. And you need to know who your peers are. So I'm not going to take an equity long short market neutral fund manager and compare him to a long bias or even a long only manager. That it's going to be totally different metrics, right? If I'm an allocator, I'm going to take a view, say, for example, on India. And if I feel that India has a tremendous growth prospect ahead of it, I'm going to max long on a long only manager. I'm not going to consider to a great degree a market neutral manager. And so the performance and the peers are going to be different, right? Naturally, the long bias or the long only manager is going to be compared to beta like the market. And then the market neutral manager will be compared to an index of other market neutral managers from like a database. And so when allocators look at these two, the comparative analysis is really, really important. Again, are you self-aware enough as a
Yeah.
manager to show upfront where you sit in that ranking, right? And are you self-aware enough to know who your peers are? One of the biggest mistakes that we see are managers who take, say, like they take like a micro cap fund return and they compare it to a large cap index. That doesn't make sense because it's a different risk exposure. It's not an actual comp. And so these little things kind of add up for allocators when they look on and how you assess yourself. And it gives them a sense of how self-aware you are, not just as a portfolio manager, even though you might have great returns, but as a business manager,
And
because
that's
you
what
are
I was
running a
gonna
business.
Yeah, exact and that's what I was gonna touch upon. It's one thing to maybe be a good trader, but then transitioning to wanna manage other people's money, it's that first impression of presenting yourself in a professional way of managing a business and managing
Yeah.
money, and that includes the self-awareness that you talked about in that presentation. But I'm curious, of the people that knock on your doors, right? I mean, you have an emerging manager platform, and the idea is you can provide them with the infrastructure and potential allocation to investors. What percentage of them come in and out of the gate, they're like, yeah, you have it. So let's say your returns are there, but you are self-aware, you articulate your edge well versus those that don't articulate their edge well and they're not self-aware. And then can you help them?
Yeah. Yeah. It's a lot of questions, right? There's a lot, that's a lot, it's a very broad filter, meaning that's a lot to filter. The teams who come to me who are self-aware are surprisingly a surprisingly high percentage, meaning that somewhere in the neighborhood of 30% are quite self-aware and they have the right attitude to learn and build, and they want to build a track record, and they're very self-analytical and they're willing to adjust and tune and go through the process of evolving. As an entrepreneur, yourself should be pretty set by the time that they come to us. But typically, even after they join us, it takes maybe a year because you have execution issues. You have, maybe you can't find the right analysts, or the infrastructure needs to be tuned a bit. You might not be able to access a market that you originally thought, slippage. But after the first year, it should have paired itself out, right? In terms of those who are successful to survive, we call it a survival rate past 3 years. And by survival rate, meaning that it doesn't necessarily mean that you perform well, but you didn't perform poor enough that you're closing down. And the reason why I use that statistic rather than the teams who graduate and become very successful, because you never know. Just like your drawdown is ahead of you, your best year is also ahead of you. So we really look at, the metric is not mortality rate, but survival rate. So typically, and you can look this up, if you managers who start on their own without a platform, like you and me, we get a dog, a spreadsheet, and we go to our garage and start trading. The survival rate is somewhere under 35%. Okay, it's close to one third, meaning that we're not going to make it to year three. Right? The statistic on our platform, the survival rate is over 65%, or that you will survive for more than 3 years. And a big part of that is because our platform removes a lot of the execution, business, risk management, and regulatory risk. And a lot of that can obfuscate or confuse and create noise for a manager who's an entrepreneur for the first time. I use a stat a lot, which, I pulled from one of the self-help videos from, 10 years ago. You only have 86,400 seconds in a day. And so you imagine you're a PM who used to work for a big buy-side firm. You've had all the bells and whistles, an entire organization to support you, hundreds of staff to ensure that you don't blow up, another hundred of staff who are there to help you drive capital and subscriptions. Now, all of that is pulled out of your universe, and you're starting a business from scratch. Before, you were spending that 86,400 seconds a day on just looking at the book, on just monitoring the markets, on just trading. Some of them even had traders internally who would trade for them, and all they had to do was stock pick. Now, suddenly they get pulled out of that, and they're sitting by themselves. You and me, we're sitting by ourselves, Emmanuel, in the
Yeah.
garage, just our dog, and we're trading, and suddenly the air conditioner goes out. Suddenly investor calls and asks, Alvin, why is the stock down 15%? I need to spend time dealing with that investor while I'm trading and monitoring the markets, right? And then someone breaks into my home, and then the dog needs to eat. There's a lot of things that are happening in a day,
Yeah.
right? So a lot of managers massively underestimate two aspects. Number one, the time, resources, and the effort it takes to hold a business together. And then secondly, and more importantly, all of the benefits that they had, all of the tools, the bells and whistles, all of the infrastructure that they had when they were in a big firm that was contributing to their alpha in the first place. And finally, third, which is a corollary to that second point, is the brand. A lot of managers don't realize that the investors were with them in large part, I would say more than 70%, because of the brand. And so there's this halo effect, this expectation that if I leave a big firm, let's call it 0.72 a millennium, and I spin out, that the same 1-to-1 ratio of allocators who were in my fund before are going to put money into my fund today, or they may grossly underestimate the discount. When reality is maybe 90% of that capital will not follow you into your own fund. Going back to the second point, the flow. So a lot of sell-side managers who come from sell-side research or from investment banking or sell-side equity trading desk, they set up their own shop. They realize very quickly that they don't have visibility on the flow. They don't see all the whales who are trading on the desk. They can't hear the buzz. And so
Mhm.
they realize sitting them by themselves in the garage or, with the dog is there's no flow. There's just barking noise. And so many of them are flying blind. And this shock effect I see every year on a couple of managers. I see them sitting in the cubicle, stunned because
Yeah.
they realize that they've gone deaf.
That's fascinating. And that goes back to what you said about self-awareness. And if the traders are self-aware and they come to you, they know that I'm going to need the support. I'm leaving a firm that has given me support, and to think that I can do this in myself and still be successful is not realistic. Those traders have a greater chance of succeeding than the ones that maybe have performed tremendously, have P&L, and are cavalier and gung ho to get things started and to move. But one question, you've talked about pedigree, you've talked about sell side, buy side in these bigger firms. And I know for our listeners and many users of Funseeder, they're not pedigree, right? They're from Main Street.
Yeah,
That's, and they, this has been the vision of Funseeder, of course, is to provide a pathway for, brilliant mathematician or somebody who's traded their own money and has that passion to go to the next level and manage money. Do they have a hope, at least in terms of in Asia, and if so, who, like, it's different. It's a
absolutely.
different ball game. It's a different, like, recipe.
Absolutely, you have a
It's a
yeah,
different pathway to
yeah.
success.
My favorite, my favorite interview from one of the Market Wizards books that Jack wrote, that the legendary Jack Schwager wrote, was Ed Thorpe, right? Edmund Thorpe was basically, I think he was like an engineer, and then he had built a systematic strategy from scratch. He's definitely my favorite, and we have a lot of Eds in the company, right? Roughly a third of our managers who come to us don't come from like a PM background, right? They don't necessarily come from a financial background sometimes either. They come from a technical background or scientific background. Some of them are physicists, for example, and they're applying sort of their worldview into how they extrapolate or profit from the markets, and that's perfectly fine. So there is hope, but what's going to what they'll need to prove in the first 2 years is their ability to learn about the business as quickly as possible. And the business side, for example, so just give you one example, a lot of these teams or early stage managers, they have a great track record from their PA or maybe running friends and family money. But for some reason you see alpha decay when they launch their first fund because it's the first time that they have monthly subscriptions and redemptions. And so why is that important? It's important because when they were running their own capital, number one, the way that they calculate the metrics is based on the capital in from day one to ITD, inception to date, right? So the track record for them is from the frame of mind that I entered in 3 years ago. What they need to really test in their models is how is the experience going to be for investors coming in, not from day one, but from day 30, day 60, day 90, year 2, year 4, where the equity curve now becomes a lot more important. And so volatility control becomes important, risk management becomes more important. And even if they've run a really low vol strategy, there is a psychological pressure knowing that an investor can pull out and redeem any 30 days creates a psychological stress on managers,
Pressure.
especially since pressure. And the pressure is not, it's not ethereal. It's real. It's palpable because that capital is what generates management fees, which pays for their income and keeps the lights on and keeps their kids in school and the rent paid,
So how
especially
did
if it's
they
a large.
Yeah, no, continue.
So just walk through, finish this thought. As they move through, especially teams with highly concentrated investors they've got to deal with that pressure every month. The NAV goes out, right? It's not sitting on your IBKR account. It's going out to investors, and you're going to expect that call on the 21st of every month, where they're going to want to break down and decipher how to break down your P&L. And that investor is going to be asking you silly questions. Why is it that Tencent is up 300% and you're only up 20? Right? Why is it that my holding in NVIDIA
But you're on.
continues to generate multiples of returns and your fund is only up 15%? And you can holler to hell and high water about how I warned you, Mr. Investor, that we are a low volatility fund, but it's still a relationship that you need to manage on a month-to-month, if not daily basis.
Yeah, I mean, I think this is a big question that we've talked to a few other people about, which is that psychology of transitioning from just trading your own money to trading other people's money, like you talked about. What are When you've seen the ones who have done it successfully and have been able to do it, like what are like one or two things that you're like, these have to be able to do this. Whether or not you could do it is one thing, but to transition over to manage other people's money, to not get flustered with the calls at the end of the month, and like to still be true to your trading. What are a couple pointers that can be helpful to those who are looking to make that transition?
I think the lowest hanging fruit that I've seen, so a couple of managers I have in mind who came from sell side research, who are now running very successful funds. The one I have in mind is a precious metals fund on my platform. I wouldn't call him autistic, but he's definitely on the spectrum. He's a brilliant mind and has fantastic research, and he knows the industry inside and out, and he's just had winners after winners. But when he interacts with investors, it's not always the most inspiring. More importantly, it's not something he enjoys. So the best thing that he ever did was hire a partner who would help him take up some of that responsibility. And that segregation of function of having a CEO who would later become a portfolio manager, actually, to help not just raise capital, but deal with investors, but deal with the business side. And of course, we help him as a platform, providing the infrastructure and the compliance, et cetera, so that he doesn't have to worry about all of the other business activities, right? So that's probably the smartest thing he did was decentralize, was delegate, segregate the functions, which ironically is what investors want to see,
Yeah, that's
because the last thing they want to see is hero ego, which is, the concept that I'm the entrepreneur, I'm the founder, I'm the best, and I can take care of everything under the sun. And you and I have both been through that stage where we feel the obligation and the pressure to carry all of the functions under our purview, when actually the best thing to do is to bring in partners to help reduce that pressure. Yes, it'll cost you a little bit of money. It might cost you some equity, sweat or otherwise, but the long-term impact is a healthy business.
yeah. So I guess what I'm hearing you say is if you're looking to make that transition and to not be influenced by these factors we talked about, but either bringing in another partner that can be the front of the house, if you will, and interact with investors, or join a platform, or just like be part of some type of structure where you're granularly focused on trading. I mean, and that's I mean, are there any like outliers or situations where it is possible, or you've seen enough to know that it's pretty difficult to just be a one man shop trading and not being influenced with your investors and having these conversations?
No, I've seen it, but those situations are typically managers who have come from the buy side. I'm struggling to find, at least statistically, it's been hard to find teams who don't have a little bit of experience run it as a single man shop. A lot of it, most of them that I've seen have struggled to some extent. Strangely enough, now that you've asked the question, I'm kind of reflecting it.
Yeah.
A lot of the teams that we work with are not just emerging managers who are startups, but we also work with expansionary managers. So these are teams from Korea, from China, who already have very established companies in their local jurisdiction, but they want to build their first offshore US denominated fund offshore. They go through a similar type of transition period where they need to learn about what it's like to raise capital globally. They need to learn what it's like, and they essentially become startup and emerging managers from scratch, even though they might be running like 1 billion or more in their country. But that's different because they have a whole team to help them make that transition. So the takeaway here is that new managers who are starting up from scratch, they're competing not just with other emerging managers, but they're also competing with expansionary managers from other jurisdictions who are going global at the same time. Is it possible still to build? Absolutely. Absolutely. And we do have a couple of teams who are one man shops who are doing very, very well. Takes a little bit longer, right? But at some point, a big allocator, call it, a Norwegian fund or even like a Texas fund, they're going to be asking for a larger team. And that doesn't just mean the platform, which we will help accommodate, but it'll also mean beefing up a little bit on the front office, beefing up a little bit on the compliance and regulation. At some point, even for us, we want our managers to graduate, to build their own company, and we'll help them apply for their own license, help them hire the team so it's well fleshed out, so that when the big allocator comes, we can see a very smooth transition from them on the platform to becoming independent with a full team support. The last thing an allocator wants is key man risk. So if you're a one man band, you are essentially embodying the key man risk, and that's something that large allocators can't afford.
Yeah, that's good, Alvin. That's good. In your region, if you're an emerging manager, well, you don't have the anchor investor yet, and you don't have that friend that you went to college with or the relationship, but you have the good performance. And let's say you are self-aware and you've done the research and you've read Jack's Market Wizards books and you're top tier. Like, where do you go?
Yeah.
How do you what is a realistic pathway to capital in Hong Kong and Singapore and Asia? Are there
Yeah, I
options?
mean, yeah, and I'm just gonna be frank, right? There are options, but you gotta hit the road and knock on those 450 doors. It's actually no different than you are if you already had a fund set up. You just have to hit the road and meet as many people as possible and show them that you have performance and get that first first investor, whether it be an SMA or an AMC. It doesn't even have to be a fund structure. You can help manage capital through an SMA, for example, privately, and that'll at least get some form of track record that will bring in day two investors. Absolutely possible. My advice is it's really a numbers game, right? We gotta hit the we gotta
Yeah, it's a numbers game, but in many ways, it's a contradiction to what we're talking about because now you have that one man trader that is now focused on hitting the road and knocking on doors and maybe impacting his trading and his focus. If you see someone who is doing that, are you excited that hey he's he's entrepreneurial to try to raise capital, or are you asking yourself the question, why aren't you back home behind a computer terminal? And I'm
I'm
asking
excited
these
actually.
like, I mean, I know it's like I'm asking these questions, but as I'm
Yeah.
talking to you, Alvin, I'm thinking to myself, this is a very difficult industry to crack in. And I'm
Hey,
trying to like come up with a
Emmanuel,
different
no,
pathway.
I'm telling you, most teams who come in, if most guys who come into my office, which is a daily basis, and when they ask me the question, Alvin, should I become a hedge fund manager? My immediate reaction is no. Don't become a manager. Don't become a money manager.
Yeah,
It's tough. It's
yeah,
hard, right? I call it the I have a young nephew, right? It's a nephew test, right? How would I answer my nephew if he asked me, should I become a hedge fund manager?
yeah,
I'd say no, absolutely not. It's a brutal industry. But if you have to ask me, then it's probably not the right path for you. Those who want it bad enough don't ask that question in the first place because they have the conviction and they have the dream and the grit, and it's something they want to pursue. We have the right to the pursuit of happiness, as you know, just like managers have the right to pursue to become a hedge fund manager. And so I'll never say no to it. Our aspiration and our hope is to help alleviate a lot of the friction and mistakes that they could make to give them the highest probability chance to grow. That's the best that we can do.
yeah.
Otherwise, there's no silver bullet.
It's competitive. I mean, it definitely, as Jack has mentioned, someone might run a 4.5 minute mile, but to be elite, like you either have to have it or you don't.
Yeah.
And, the theme in talking with a few different guests that we've had on our podcast is, we were interviewing John McCauley, who I was talking to you about earlier on mindset. And one of the things he mentioned is that the best traders he's seen that have an ability to grow and be successful are the ones who are in many ways stubborn and not really impacted by outside influence. So, you know,
Yeah.
other people's
I totally
opinion
agree.
that they can't make it or not make it, they're like, no, I'm gonna make it. So for them to
Yeah.
actually ask a question like, do you think I can make it? Or like what are like it's maybe it's a little bit, it's a flag in
It's a
itself, or it's a little
yeah.
pause of their career objectives.
Yeah, it's self-selection, right? It really is. And it's daunting, right? It's like, gosh, but life is daunting, right? What do you tell? No, I can't recommend that you take this path, but I think you should certainly try. When we look at the competition compared to say it was, 10, 20 years ago, in Hong Kong, we have, just to give you some numbers, in Hong Kong, we have roughly 1,800, almost 2,000 registered, licensed investment managers in just this one city alone. And when I built the company, the business plan was looking at helping China managers come to Hong Kong. And if you look at the number of China managers who are registered as private hedge fund managers or private equity managers licensed in China, it's 20,000. There's 10 times more licensed asset managers just in the hedge fund and private. That doesn't include the mutual fund space. In China, 10 times more than there are in Hong Kong, right? And Hong Kong is one of the biggest financial hubs, at least by AUM and by strategies, in all of Asia. So anyone who's starting out today here in this city or in Singapore, just the one-way competition is massive, let alone the global competition, right? I don't think there are that many hedge fund managers when Ed Thorpe were starting, or the early interviewees of Jack when he wrote the book.
It's become much more competitive for sure. So I'm curious right now if you're seeing certain themes or strategies that Asian allocators are looking for. Like, there's a variety of strategies, and I was speaking with Neil Berger, and he's saying a lot of focus on Japan. In fact, then somebody else I was just talking today said they're coming out of Japan, and that's not in your region. But thematically, I would imagine sometimes you're like, okay, there's something hot. People are interested in these type of managers and strategies. What strategies right now are garnering attention?
Yeah, there's a lot of attention in Japan. I still don't understand why. Yes, there's a narrative that, there's some M&A potential catalyst for M&A activity as larger conglomerates are specializing and so breaking up the companies and then these can be revalued up. There's that trade. We're still on the tailwind of the Buffett trade where you have a lot of capital flows coming into Japan because of a reflationary environment. But the fundamentals of the country are not that exciting to me yet. There's a tremendous amount of discorporation or failures at the large corp level. I mean, SoftBank, as of the time of this recording, dropped almost like 20%, I think it was, over the last couple of days. And you look at the car manufacturing sector, you look at the traditional manufacturing sectors, they're not doing so great. Consumer demand is improving, but it's not as exciting to me yet, or it has been, because just the numbers have been kind of weak, not to mention the demographic as well. At this, it might become a self-fulfilling prophecy. If enough US dollars flow into the US, then it will naturally create a revaluation. And I think this is why there's um, this gap between how local managers feel about the economy versus external investors. Local managers are not as bullish as external managers are. And I'm trying to figure out, even for myself, where the happy medium is. Korea, on the other hand, has been an incredible outperformer. I think the Kospi is up over 70% year to date. And it's been a dark horse because historically there's this Korean discount because the family offices and the families who own these companies and control them have been artificially suppressing the stock prices. Now, new rules from the new administration who came into effect over the summer are realigning the interests between minority investors and the families who own these companies. And so we're seeing a very, very dramatic revision in these numbers, not to mention the fact that de-risking of U.S. assets is now flowing broadly into emerging markets, not just China, not just India, but also to Korea, obviously Japan and Southeast Asia. Generally, what we're seeing is quite a bit of bullishness across Asia right now. China has been a sleeper for the past few years, but you know me, I was calling Max Long on China 2 years ago. I was on Twitter, not on Twitter, on LinkedIn, calling this, and the backlash on it was ridiculous. Here we are, markets are up 50%, second best performing market in Asia. And now allocators are visiting us asking, where do I max long? I'm not saying that the price up is over. There's still a tremendous amount of value to be had, but I think China is probably the elephant in the room for now. And we'll see on the private side, we're going to see a lot of activity in Southeast Asia because the China 2.0 or the China Plus story, meaning that you have a lot of capital that was captured in China previous generation who are now flowing into Singapore, into Vietnam, into Thailand. A lot of privates are really excited about being on the ground there, albeit a more shallow market.
Yeah, that's great. Well, this is great, Alvin. I know there's been a lot of wisdom you've imparted to our listeners. Any other parting advice to an emerging manager, starting off, looking to meet to allocators that they should know? I mean, you talked about edge, you talked about, articulating self-awareness, or perhaps on the flip side, red flags, like don't do this.
Yeah, like there's a lot. I'm actually going to be on a panel this afternoon, just going through all the do nots. And I don't have any, the basics are super important, right? The basics are super important. You got to have everything well documented. You got to be self-aware to the extent where let's take drawdowns, for example. Every manager has a drawdown, and everybody also wants to show only the best performance. Do not obfuscate that. In fact, if anything, I would build whole slide just talking about that drawdown. so that you're up front and center with the investor, and more importantly, using that as an opportunity to show how you've grown and built up and improved since that drawdown. There's a tendency for managers to, or even early stage managers to stop communicating. Your job as a PM and as a business person and as a CEO and a CIO is to hyper communicate. So
Good.
that means when the market is up and the market is down, you have to keep tabs with your investor base so that they know the path that you're going through, even if they're not replying. Right before, you get emails congratulating you, great month, well done, keep it up. If they go quiet, you still got to keep talking to them, because I know for sure they are listening. Right, there's a team who's in Hong Kong right now. They've had a brutal year, not a brutal but kind of a mediocre year. It's a crypto fund. Bitcoin's up like, I don't know, 100%, and these guys are kind of like single digit, low double digit, and they're underperforming, right? And a lot of investors are a little bit impatient because, you come from a great background, great pedigree, but you're not able to you capitalize on a high beta environment. But you know what? They still came out to Hong Kong. They still sent out those emails. They still set up those calls. And they're still going to be able to raise money because they're showing a level of professionalism that inspires loyalty. If not in new investors, certainly to help retain old investors who are probably thinking whether or not they should redeem. And redeeming capital, or keeping capital from going, is far more important sometimes than raising new capital. So I hope
So
that
what I
was a
hear
little
you
bit.
saying, and it's brilliant, and it's kind of the prevailing theme that we're hearing when I'm talking to people, but be persistent in communication and transparency. Like, no
Yeah.
matter what.
Yeah.
Like, that's
Yeah. In fact, on transparency, just as a last note, right, there are a lot of quant managers now who are hyper focused on protecting the IP of their trading strategy.
yeah.
I can tell you, for 99% of the allocators that I talk to, they don't have the confidence in you yet, nor the time to decipher from your trade activities how you generate your alpha, if it's really that good. And if it is that challenging, meaning that it's almost a black box, they might not even care to take the meeting in the first place. So you have to be very clear about how 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 protective you are of your IP versus the marketability of your approach. Meaning that if you're not transparent enough, you won't raise a dime,
Yeah,
right?
that's
And
true.
if you're, of course, if you're too transparent, then you have to run the risk, of course, of allocators cherry picking, or understanding better your strategy. But I've seen 99% of the strategies I've seen are really not that special, but more about how they're taking that strategy and applying it. Could be timing, it could be allocation, it could be leverage, right? But it's really, really hard to differentiate yourself these days. So, trust, allocators. There are a lot of very well respected investors out there. Go to them and be comfortable disclosing, your overall strategy to them, because quite frankly, they have a lot more money housed with a lot of other managers to focus on cherry picking yours, on day one.
Thank you so much. This was very valuable to our listeners. Where can they learn more about you and OPIM?
Yeah, check us out. We're on opim.com.hk, or you can check out our YouTube channel. We're at Alpha Uncovered. Please do subscribe and like, and we'll see you on the next one.
All right. Thank you, Alvin. Thank you for joining us on the Funseeder Rise podcast, where we spotlight exceptional independent traders from around the world and explore the future of active money management. To learn more about Funseeder, our mission, and how we support emerging managers globally, please visit us at funseeder.com. The information shared in this episode is provided for educational and informational purposes only and should not be considered investment advice or an offer or solicitation to invest in any fund or trading program. Trading futures and other derivatives involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Until next time, stay curious, stay disciplined, and keep rising.